Japan has their rate hike in. Is the bottom near? We'll break it all down for you. Let's just jump right in. I do want to thank our sponsor, and that is BTCC. When you are in times like right now, where you see these volatile moves up and down, the only way to play the market is to get into shorts, longs, and do, of course, some copy trading. You guys can do that all over on BTCC using our link down below. It's going to get you a 10% bonus when you do your first time deposit. So you put $1,000 in there, you're going to get $100 on a bonus. It is very easy to sign up and get going. And you have a whole slew of unlocks as well as 40% lower trading fees. This is the place to go if you're going out there and doing some trading. I'm hearing some good things about this, so check it out. Use our link down below. Get started right now if you're getting into crypto. Let's get into it. Of course, one of the things that we've been all wondering is how the Japanese rate hike would affect the markets. The 10-year yield rose 2% for the first time in nearly 20 years. This is something we've been seeing. The decision was fully expected and passed unanimously. UEDA, of course, struck a cautious tone around real rates that are still negative. Conditions still remain a little bit loose here. And also, if you look at the markets, they took it pretty well. When you look at the dollar versus the yen, which edged higher, Nikkei was steady, and risk assets were somewhat supported, so meaning crypto. And of course, no signs of carry trade stress or the hawkish surprise, which is the big issue. The carry trade is the one that we are a little bit concerned with. And remember, forward-looking statements out of the Prime Minister there in Japan has been something that we've been looking forward to. And of course, she has been playing it pretty tight. So the fact that their version of Fed went this direction is probably good for the markets in general. They have reached the end of the road, though. It is trapped between rising yields and a fiscal crisis, or using the BOJ to help artificially cap yields. That's going to be the thing that plays out now going forward. And there's some things that they're going to do to make this unwind slowly. So I anticipate that we will see an alternative move on many of these assets, U.S. Treasuries mostly. But obviously you see there the sharp fall in the yen as a sign of things to come. This is something we're watching very closely. I want to go to this next clip, which goes into how more rate hikes are coming. Take a look.
We expect that the terminal rate, 1.5%, will be reached in the mid-2027. So this is still a long way forward. And as you just mentioned, that this is a very slow process. What the BOJ is doing is the structural change of the Japanese economy, where we have been trapped in the deflation in the last 2 decades. The inflation rate has always been around zero. But now we are moving away from deflation trap and migrating to the new equilibrium where the inflation is normal, roughly every 6 months. So next rate hike we expect is July 2026.
I don't know if this plays out for Japan. I know the strategy they're trying to work is easing into it, trying to offset how the economy can basically respond to it, especially from the investment crop that comes out, and a major investment angle globally of how the Japanese have been basically borrowing low and, arbitraging into other assets. That the thing is going to be interesting to see how this plays out over the next 2 years. One thing that is not playing out is the U.S. labor market, because that is now suggesting that the economy is in a recession. Wow, they actually agree with me. And I agree. I think, it's been in a recession for a little bit. We have continued to see unemployment at a problem. It's interesting, though. I don't think we're getting the full clarity here coming out of the BLS, and definitely not getting it out of the administration. This has been something that has been, I think, dealing with the American population for quite some time, really about the last 10 to 12 months. And I think it's going to extend into next year by quite a bit. So this is the U6 unemployment rate, which includes persons marginally attached to the labor force. And now they're just reporting in. That, of course, is up again. And then also this captures people who want a job and have stopped looking. That's another factor that goes into it, into a recession. And that's the problem that you're dealing with right now, which is this rising curve that is not a good look going forward. So remember, 2008, that's the kind of curve we're looking at right now. And this was not a good day when we had 2008, 2009 unemployment numbers in double digit. That would be detrimental to the markets in general. Other things that we have to kind of look at is almost never in history of the U.S. economy has consumer sentiment been this depressed. And I would agree with that. I think we are in a position right now outside of the 1%, which is driving the S&P 500 to all-time highs, gold to all-time highs. Most people, working class people, this is the kind of sentiment that we continue to see coming in from the Michigan Consumer Sentiment Index. And I think this is the thing that I'm most concerned with of how do they unwind this sentiment and get it back into a positive mode with inflation still at risk. I know the inflation numbers that came in this week were supposedly lower, but I'm still not believing that. That data just does not rhyme with what we're seeing right now in the real world. The administration, I think, can say all they want. The reality is this is not going to paint out well. Now, granted, you have one or the other that you have to deal with, higher inflation or, Americans losing their jobs. I think you have to be able to offset the American losing their jobs and dealing with higher inflation versus a little bit of both, which is what Powell is going to be dealing with right now. Here is Fox trying to twist the numbers. Take a look.
Month.
That's 41 million homes sold on
4.13 million.
4.13 sold on an annualized basis.
Yeah.
That is not strong at all. That's just not.
Here we are.
Also, latest read on consumer sentiment. What's that number?
It surprise drop to 52.9. This is a December number. It's the final number, so it's pretty recent. Consumers are just worried about the price of things and long-run inflation expectations as well.
But with rather these dull numbers, the market seems to like it, perhaps implying that we'll get more Fed rate cuts.
Actually, the market went up a little bit on both pieces of information being slightly weaker than expected.
The weakness, I think, is attractive. Bad news is actually good news for the market. Yeah. Maybe. That's what we've got.
All right, guys, this is the thing that I always say, and that is it is the haves versus the have-nots. And that's what you're dealing with right now. And I think most people in the crypto sphere, unfortunately, are there because in some way or another, you've been in a have-not position and you're trying to make it to the next level. The problem is that the haves have continued to drive this market on the S&P 500 more and more up. I mean, we continue to see all-time highs. It's up again. I'll talk about that in a second. But yet, crypto is looking like this. This is where we are right now in the crypto market at a 21. Past the 4-year cycle window, if you want to call back and say, okay, the 126 was the 4-year top, okay, then we definitely are in a position where we had one of the most lackluster crypto bull runs ever in the history of crypto. And I think this is something that also plays out is that we may not be seeing crypto bull runs again. And here's why. You're dealing with an institutional model now that is much more patient. They're much more calculated, and they're fully willing to dump and buy based on retail's interaction with the market. And the problem is that most of retail that's been in crypto for the last 10 years, 5 years, 3 years, whatever range you've jumped in, you've been looking at historical engagement, not looking forward to treat it like a traditional Wall Street market, which is what they're looking at. And I think that is the issue right now because it goes back to the problem with the haves and the have-nots. So much so that IBIT, this is the mighty IBIT, is the only ETF on the 2025 flow leaderboard with a negative return for the year. This is not good. It does not look good for Bitcoin, and it definitely does not look good for crypto in general because it's showing that crypto cannot hold its weight in the ETF crowd when it comes to ranking into the top 10, top 5. Look at some of these returns. I mean, you're seeing 28% on IEMG. You've got 30+% on VXUS. These are the kind of opportunities that are out there. 64% on IAU. So those are the kind of things that we are faced with right now, how Wall Street is playing into this. Now, many people will say, well, Paul, this is the Wall Street natives pushing this market down so they can enter in. And I get that, but it's buckus in my opinion. This is just traditional market strategy that's always been around in Wall Street for the last 40 years. It's not changing. Crypto is just a new toy. It's just a new stock to them, a new play into the market. And I think you have to change the way that you are playing this market now. You cannot look at this historically like what we have seen in the past. Now, I've been a fan of Mike Alfred, and I won't say I'm not a fan of him, but I don't think he has played this right in the sense that he is kind of a perma bull when it comes to Bitcoin. But his statement here, bears had numerous opportunities to push Bitcoin sustainably below 86. I think it probably will continue to see that. They've had the cycle narrative and a chart, Squiggler Brigade, on their side. And then they also try to scare folks with the things like the Japanese yen carry trade. I don't know that that was a big scare because the S&P barely blinked at that. And that's where liquidity is going to be coming from. So I'm not necessarily on the same camp with this. Now, do I think that Bitcoin can catch a wind under it? Yeah, pretty much. It will depend on how Wall Street wants to do it. It's going to be the institutions that drive the narrative around it. The one area that concerns me the most is going to be altcoins, because I don't know that an altcoin outside the blue chips are going to get underneath this unless they are fighting for the trenches and only in the trenches. That's a different game all in itself, but expecting retail to come in like what we've seen in the past, I don't know that that's going to be going on. A couple of things to consider here. Coinbase did all their announcements. They're very cautiously optimistic right now for 2026. Tom Lee's very optimistic for 2026. But again, look at the headline right there. Crypto nears institutional inflection point. That's all you need to know to play this market. Follow the institution. If you've been following stocks for the last 5-10 years, you understand this game. And I think that's the disadvantage that unfortunately crypto traders are dealing with. They have to understand they have to understand how these markets move. You can call it what you want to call it. Many people will use the M word. But if you understand it, you know how to play this. This is going to be a game of trading now. And that is getting your long in, getting your short in. And that's the way you're going to be able to make gains. I don't necessarily like leverage, but this is probably going to be the way that people do it. As long as you don't over leverage, if you get in there on the risk level, maybe that's the route. The way that this is winning for stocks, because it has been doing this for 30 years, and the U.S. stocks extend gains, continuously dunking on the market right now, is the NASDAQ 100 up another % and hitting another all-time high. S&P 500 right now at 68.22. I mean, come on, guys. This is just outlandish to see this kind of performance when inflation out of control, jobs on a spiral up. Basically, they're trying to get the last of the turkey leg that's still on the table is what I'm getting at here. And this is how the market is playing out. Now, there's a couple of analysts that still believe this is very, very bullish for the market. Listen in.
I'm really surprised that the yen has continued to weaken here. And I say that in context that, as you know well, Anna, I'm a structural yen bear. But I actually thought that this press conference, in context that Governor Ueda is always a very cautious individual, I don't know what people were expecting. He was never going to be more hawkish than this. Sure, he wasn't particularly hawkish, but I thought he was about as hawkish as he was ever going to be.
Mark, did the market overreact to that US CPI print yesterday? A lot of skepticism from economists. So much do you trust this drop in inflation?
Yeah, I mean, what's interesting is how quickly markets did this kind of dismiss it. So markets, the yields did not react to much.
Okay, I'm going to ask you a really dangerous question now, Mark. Are we done with 2025? Can we all take some time off and come back for 2026?
No, but look, I think this is a market where the price action suggests that the technicals are a little bit fragile. The market is very bullishly positioned, and I think structurally, as we've discussed a lot, I expect stock markets to make fresh record highs in 2026 easily. I think it'll be a good first half of the year because of the structural tailwinds. But I think there are some problems there in terms of risk aversion side that have played out. And again, I still draw attention to the fact that the digital asset treasury companies continue to trade weaker and weaker. That spreads into the crypto sector. That spreads into retail sentiment at a time they're getting squeezed by Christmas. And that kind of weighs on the favored AI names, the meme names, and that's why I think it's going to be problematic for another couple of weeks.
Here's a word from our sponsor, Mevaloxy. I've already talked about this platform before. It's not your ordinary staking platform. It's a project that uses a network of MEV bots to generate profit, something that was previously only available to big players. You guys, of course, can visit their website just over on Mevaloxy.com, learn a little bit more about what they're doing. And I think when you compare staking versus MevStake, you might get an idea of how valuable this could become. To put it simply, users deposit funds into liquidity pools managed by MEV bots. These bots perform blockchain operations, particularly sandwich strategies, and earn from blockchain network inefficiency. That's why the system continues to perform steadily through even market downturns. They've also launched a recent app, which you can kind of see here on their website. Their developers are out there taking questions, which is great. I love to see that in terms of interaction from a project like this. And when you compare what they're doing there, along with the fact that they've got this new app out there, just search MEVStats over in the Apple phone store. And of course, you guys can learn a little bit more about that. They also have an Android app getting ready to drop. So that's a pretty big deal. I think these are the things you have to have when you have projects like this. Don't forget also, this brand and project is getting a lot of press as well. Obviously, they were at Token 2049. You probably saw a little bit of what they were doing over there. Of course, they've started to make some of their lines into other components out there. And of course, that means places like investing.com and others that have started to cover this platform. So that's a good thing. I think the scenario that plays out in this is, where and what are you guys going to do during these cycle upturns and downturns? Make sure and visit Mevaloxy.com. You can, of course, use our link down in the description. Make sure and use that one because it's a pretty key link, and you get a discount and a bonus when you use it. All right, so there you have it. I'm just going to show you guys. This is the S&P 500 versus Bitcoin. Just the charts, okay? One on the left, S&P 500. One on the right, Bitcoin. I mean, you begin to understand why we are seeing much more activity right now, because the liquidity hasn't moved into risk assets yet. That is the factor as to how the strategy and the psychographic of institutional capital is going to move into this market. That is all you have to really consider right now, with Bitcoin, of course, holding not badly, considering where we have, but it is definitely in a sideways chop. All right, so just look at the last 30 days if you kind of understand where the S&P, sure, we did have that little bit of a clip down in October, but right back into it again, holding back up maybe to where we could see that all-time high again on the S&P 500 starting to brew in. Again, with Bitcoin, it has been a downward spiral, which is why you saw the IBIT numbers coming in like you did right there. One other thing that could change things a little bit is the reaction to tariffs. And right now there is a 72% chance on the Supreme Court ruling against President Trump's tariffs. And how this unwinds, I have no idea of what all those tariffs that were collected, how that would even work in terms. I'm assuming that if the company or if the country collected it during that period of time, do they just keep it? I don't know. We'll find out. What I do know, it's going to get messy. We're probably going to see a lot of lawfare in the coming months over all of this. This is the other thing that's going to play into this, because this, of course, plays into the issue that we all are dealing with, and that is, do we see continuation of interest rate cuts from the Fed? Well, Trump is saying, I'm going to announce it. Next Federal Reserve Chairman, someone who he believes will lower interest rates by a lot. A lot. We'll see if a lot means, down to 1% again. If that's the case, hyperinflation on its way, running rampant, unemployment, dogs and cats living together. I mean, it's just going to be mayhem out there. But don't worry, because when you have mayhem like that, well, you need mayhem in other ways. Take a look.
In the fall, we will host the first ever Patriot Games. One young man and one young woman from each state and territory.
One young man and woman to fight to the death in a pageant of honor, courage, and sacrifice. This is how we safeguard our future.
I just love that.
Man, we have devolved into a species I'm not sure should be credible to walk among this beautiful earth, but there you go. Patriot Games, here they come. Coming to a DC theater near you. Make sure and do one thing, guys. Get into a group that cares about how you can go forward. The way you do that is join the Bear Market Edge. Super easy, and it's free. All you have to do is hit the link down below and hit me out there on X, @Paul Barron. We'll catch you next time right here on The Paul Barron Show.